Hey guys, welcome to the Art of Position Sizing, a masterclass on mitigating risk. In May 2022, the Terra ecosystem collapsed. Luna, which had traded above $100 just a few weeks earlier, had crashed over 99.99%. USC, its stablecoin, lost its peg and never recovered. Over $40 billion erased from the markets overnight. In South Korea alone, over 200,000 retail investors filed for losses. Wedding savings, retirement funds, life savings, all gone overnight. Forums had suicide lines pinned at the top. But here is what nobody's talking about. The post-mortems all focus on the mechanisms. The D-peg, the death spiral, the anchor yield. And yes, all of those were important, especially if you're a regulator or a developer. However, for the vast majority of people, the problem was something else. The coin wasn't the problem. The sizing was. I knew people whose portfolio were 80% Luna, and I knew other people who had 4% in Luna. Same coin, same thesis, same week. One was wiped out, one took a bruise and moved on. The goal of today's video is to give you a 4-question checklist you can ask of any position in your portfolio to know whether it can kill you or not. Not a formula, but a thought process. A thought process used by institutional desks all over the world to make sure a single position can't take them out of the game. Let's get into it. Have you heard of the Kelly Criterion? Developed by John Kelly in 1956, the goal was to create a formula that answers this very question. How much should you bet? Imagine a blackjack player who knows how to count cards. He has a real edge over the casino. Now he needs to figure out how much he should put on each bet. Too little and the edge doesn't compound fast enough. Too much on a single hand could cost him everything. Kelly tells him how much to bet on each hand. Given an edge, what amount of your capital should you put into an investment to outperform over time? Ed Thorpe, a mathematician, became famous for actually beating blackjack in Las Vegas by using the Kelly formula. Years later, he ran a hedge fund called Princeton Newport Partners that compounded at over 19% a year for nearly 2 decades. Same formula, different table. Here's the formula on screen. F equals P minus Q divided by B. It sounds complex, it's not. Let me get into it. Let's start by labeling what each part actually means. F is the fraction of your bankroll to bet. P is the probability of winning. Q is the probability of losing. And B is the payoff if you win. That's it, 4 variables. Let me give you an example. You believe investment has a 60% probability of working out. If it does, you're expecting a 3x. If it doesn't, you lose everything. In this scenario, P is 0.6, Q is 0.4, and B is 3. Q divided by B is 0.133. 0.6 minus 0.133 is 0.467. Kelly says bet 47% of your bankroll on that investment. Pause and think about that for a second. The math is telling you to put almost half of your portfolio on a single position. That's exactly where Kelly starts to break. The math is assuming your probability estimate is perfect. It's not. In financial markets, your estimates are noisy guesses dressed up as numbers. Your edge is much smaller than you think. Kelly was built on binary outcomes. Either you win or you lose. Crypto isn't binary. The payoffs are continuous, the probabilities are subjective, and the very inputs of the formula needs are the ones you can't actually measure. This is why nobody serious uses full Kelly. That said, I know some very sophisticated investors, and many of them apply Kelly. However, they only use it to a certain degree, also known as half Kelly or quarter Kelly. In our example, instead of 47%, half Kelly is around 23.5% and quarter Kelly is around 12%. The math captures the edge, the fractional approach captures your humility and knowing where your limitations are. Nobody gets it right all the time. Ed Thorpe himself has publicly written that his trading strategies only used a fraction of the full Kelly. The takeaway I want to leave you with here is even with the best mathematical framework we have, the answer it produces is still way too aggressive for financial markets. Anyone serious has to build safeguards on top of it. Those safeguards are what makes the difference between the Luna holder who got bruised and the Luna holder who lost everything. Let me give you all 4 of them. The first is conviction. Kelly assumes every bet is equal in quality, but in reality, that's not the case. Some are based off years of research and deep analysis. Others are based off a friend's hot take and an X-thread. Serious investors rank their theses: data quality, time horizon, asymmetry. Each thesis gets a conviction score. Position sizing is tied to that. The second adjustment is volatility. A position in Bitcoin and a position in a meme coin are not the same thing. A meme coin can move 3 or 4 times the amount of Bitcoin in a single trading session. So you can't size positions by dollar amount. You have to size them by risk contribution. Take a $250,000 portfolio and you decide no single position should be able to move your portfolio by more than 1% on any given day. That's a daily risk of $2,500. An asset that swings 5% on a given day would cap around $50,000. The math is simple. $2,500 divided by 5% equals $50,000. You can hold $50,000 of that asset. When it swings 5%, that's $2,500. An asset that swings 10% on a given day must be capped at $25,000. Same risk, different size. Our next adjustment is liquidity. I've seen this one catch out hundreds of investors, and many people don't understand how it works. They go in, they buy 2% of a token, they think they're up millions of dollars, and when the time comes to sell, they realize they have 5 figures at best to pull out. A position is not a position if you can't exit safely. You've probably seen when making a trade the word slippage, but very few people actually know what it means. Slippage is the difference between the price you see on screen and the price you actually pay. Imagine a token trading on a DEX that has $2 million in liquidity. A $50,000 buy might execute at a 2% slippage. 500,000 buy might execute at a 25% slippage. The numbers on the screen were exactly the same. The question you have to ask yourself before entering a position is, if I had to exit, could I sell without losing most of my gains? Our fourth adjustment is the hard cap. Even your highest conviction, lowest volatility, most liquid investment needs a hard ceiling. In the best portfolios, positions are capped at the level where even going completely to zero, it wouldn't destroy the portfolio. Heck, it shouldn't make too much of a difference. That's a rule that, if applied correctly in 2022, would have saved hundreds of thousands of people from the lunar crash. Let me give you an example. Let's use our 4 filters to see how they would work together. And remember, conviction, volatility, liquidity, and hard cap. Let's circle back to that $250,000 portfolio again. Step 1, let's use Kelly to give us a starting point. In this example, let's say the fractional Kelly gives us an estimate of 15% of our book. In that case, that's $37,500. Step 2, conviction filter. The thesis is strong, but it's not perfect. Let's say 4 out of 5. That means trimming the position down by around 12%, leaving us with $30,000. Step 3, volatility filter. The asset moves twice as much as the portfolio average, so you cut the position in half. Now we're down to $15,000. Step 4, liquidity filter. Let's assume the asset has lots of trading volume, so we can exit whenever we like, and there's no adjustment required. And even further, let's say our hard cap is set at 10%, and with this new size of around $15,000, it's well below the 10% threshold. Our final position is $15,000. Compare that to the start of $37,500. Same conviction, same thesis, but a very different sizing. Doing this exercise results in having a portfolio where no single asset can take you out of the game. Position sizing ultimately is not about maximizing returns on the upside, it's about mitigating the losses on the downside. I want to leave you with one final idea as part of this video. There are 2 ways you can measure returns when looking at your portfolio. The first is the average. Add up each year's return and divide it by the number of years you've been in the game. That's called your arithmetic average. It's a number most people pay attention to. The second is what actually happens to your money. What it's worth now compared to where you started. That's called the geometric outcome. Most of the time, these 2 numbers tell a very similar story, but in markets like crypto, the outcomes can be very, very different. A portfolio that compounds at 30% for 10 years will leave you roughly with a 13x. That same same portfolio returning 30% for 9 years and then negative 80% in the last years means you basically break even. The arithmetic average still looks very healthy on the second portfolio, but from a geometric point of view, it's obsolete. That's what poor position sizing does to investors. It can absolutely wipe a portfolio. You can win 9 out of 10 times, but that one loss can completely destroy you. One oversized mistake wipes out every right decision that comes before it. And with that, thanks for watching.